A credit score looks like a number. But behind that number sits a hidden machine deciding who can rent, borrow, insure, or build a life. Millions obey the score without seeing the rules. That is the power of invisible algorithms. They turn personal history into a gatekeeping system. The credit industry is not one company. It is a network of bureaus, model vendors, lenders, and data brokers sharing the same hidden ledger. The money begins with access fees. Lenders pay to score risk, consumers pay for monitoring, and every transaction feeds a profitable surveillance loop. This is institutional design at work. The system is built to look neutral while quietly transferring power from borrowers to scoring institutions. The score compresses your financial life into a single signal. That compression creates systemic flaws, because nuance disappears and errors become expensive. A missed payment can echo for years. A temporary crisis can harden into a permanent penalty, even after the original hardship is gone. Errors are not rare exceptions. They are structural outcomes of mass data collection, where one mistake spreads across lenders like a contaminated file. The bureaus thrive on repetition. The same information is bought, packaged, and resold, creating hidden margins from data that consumers cannot easily challenge. When customers dispute records, the response system often feels designed to exhaust them. Friction is not a bug, it protects the margin. Regulatory capture helps explain the silence. The rules are written inside an ecosystem where oversight depends on the same industry it should restrain. Consumers rarely negotiate the model. They inherit it. That asymmetry gives the scoring industry enormous leverage with little direct accountability. Lenders do not just read scores. They tune thresholds, layer filters, and build automated rules that quietly amplify exclusion at scale. Everyday payments now matter more than ever. The algorithm watches the ordinary costs of living and converts them into a measure of trustworthiness. The opacity is the product. If people understood the model too well, they would see how arbitrary many decisions can be. New scoring systems claim to be smarter. They widen the surveillance net, pulling in alternative data from phones, apps, and online behavior. Each permission becomes a revenue channel. The economy of credit is expanding from borrowing history into behavioral extraction. Small businesses feel it too. Their access to inventory loans, merchant cash advances, and working capital depends on model assumptions they cannot inspect. That creates a geography of credit. Entire neighborhoods can be marked riskier, not because of character, but because of inherited data patterns. The past never really disappears. Old redlining logic can survive inside modern datasets, reproducing inequality with a cleaner interface. The profit margins are more hidden than they appear. Fees from monitoring, alerts, disputes, and premium access turn fear into recurring revenue. Meanwhile, the consumer bears the cost of delay. A lower score can mean higher interest, more deposits, worse terms, and lost opportunity. Even a small score difference compounds. A few points can cost thousands over time, making the algorithm a silent tax on uncertainty. Automation makes refusal feel objective. But if the model is built on biased inputs, speed only accelerates the mistake. This is why the system is so durable. Every actor profits from the chain, so no one has a clean incentive to break it. Lobbying reinforces that durability. Complex rules and compliance language can protect incumbents while making reforms sound technically impossible. Dispute systems often shift the burden back to the individual. You must prove the machine wrong, even when the machine holds the evidence. The hidden ledger reveals the real business model. The score is not just a metric, it is a product, a tollbooth, and a control mechanism. Data brokers intensify the problem. They package fragments of identity and sell them into systems that consumers never consented to fully understand. The score now reaches beyond credit cards. It shapes insurance pricing, housing access, and even the terms of everyday financial survival. That expansion raises the stakes. One model increasingly influences multiple markets, multiplying the damage when its assumptions are wrong. Public debate often focuses on fairness language. But fairness can become branding when the underlying institutional design stays unchanged. Real reform would demand transparency, dispute rights, and limits on data extraction. Anything less leaves the architecture intact. The solution is not to pretend risk does not exist. It is to build a system with accountable models, human review, and visible rules. Until then, invisible algorithms will keep acting like private law. They will decide who gets mobility, who pays more, and who stays trapped. The credit score files are not just about numbers. They are about power, profit, and the hidden architecture of modern exclusion. Subscribe for more.